Hello guys, you're welcome to this part of the course. My name is Sanyaolu Oluwafemi. This is financial accounting made simple, and we are going to be looking at the different aspects today compared to other aspects that we've looked at previously on this course. So for today's class, we are going to be looking at accounting equation. However, before we start looking at accounting equation, let's go over the course approach. Now, I understand that when it comes to accounting, a lot of students have phobia for accounting. A lot of students do not like the word accounting, and that's because of probably what they must have been told about accounting. Now, one thing I must make you understand is that accounting is very, very simple. It's what you do on a daily basis. So the first thing is, the approach I want you to have for this course is to have an open mind, be willing to learn, and eliminate any form of fear that you may have in respect to accounting. That being said, also note that accounting just requires simple arithmetic such as addition, subtraction, multiplication, division. Those are the prerequisite knowledge that you need for this particular course. Like I said, accounting is very, very simple if you can just follow the step-by-step guide that I'm going to give you in relation to this course. In as much as you can go to the market and make a purchase and know exactly how much you're expected to collect at the end of that purchase, then accounting is for you. Accounting is very, very simple. All you need to do is just to be committed and be serious minded. Now, there is no hard and fast rule. You need to prepare. Just like mathematics, you need to practice. In accounting, you also need to practice to become a pro if you want to really practice accounting. Now let's go over the course outline. Now the first one, we are going to be looking at introduction to accounting equation. What do we mean by accounting equation? Then we are going to look at the types of accounting equation that exist. Don't worry, I'm going to breaking it down step by step in order for you to be able to understand whatever that we are going to treat today. Then we are going to look at basic terms, breaking terminologies that are used in accounting. Then I have a practice question. Then after the practice question, we are going to do a review of everything we've done. Then lastly, I'm going to give you an assignment, and I expect you to submit the assignment at the end of this particular course. So let's dive right into it. So we're going to look at the introduction to accounting equation. Now, under the introduction to accounting equation, let's look at the definition of certain terms in respect to accounting equation. The first one is assets. Now, what are assets? Now, you must have heard of the word asset before. Assets are those possessions that a business owns, or those properties that an individual owns. For example, if you have a car, you have a building, you have a land, you have a motor vehicle, a van, a truck, all these are assets. All these are assets. They are assets belonging to a person or assets belonging to an organization. They are valuables that the organization put to use. They are assets that are used by the organization in order to generate income, future cash flows. So all these are referred to as assets. Now, we have different types of assets. We have the first one we have there is the non-current asset. Now, what do we mean by non-current assets? Now, non-current assets are the tangible assets of a company. They are the tangible assets of a company that exceed beyond one accounting period. Now, most times organizations buy these assets in order to use these assets within the organization. The purpose of the asset is not to resell. The purpose of the asset is to use the assets within the organization. For example, a company buys a motor vehicle or a motor van for the purpose of delivery. Of course, that motor van is going to stay more than 1 year in the company, because the company will not be buying a motor van every new year. Of course, it's possible for a company to be buying every new year, but it is very rare. So the company will buy, and after maybe a couple of years, they will replace. So usually the same thing too with building. If a company buys a building, the building is expected to last more than one accounting period. The same thing too with furniture. The same thing too with land. once a company buy this asset, it is expected that this asset will last for more than 1 year. So anytime a company buys an asset that is non-current in nature, it is expected that this asset will last for a period of more than 1 year. Now, the second category that we have is the current assets. Now, current assets are assets, they are classes of assets that changes frequently within one accounting period. They change frequently within one accounting period due to business transactions. So, for example, inventory. Inventory are those raw materials or finished goods that an organization buy for the purpose of reselling them. They are the what? They are those materials, those raw materials or finished goods that an organization buy for the purpose of what? Resale. Then cash in hand. Cash in hand. Now, when we talk about cash in hand, if an organization receives cash after every transaction is completed, of course the cash will either increase or decrease depending on whether they are paying out cash or they are receiving cash. So if you are paying out cash, of course your cash will what? Reduce, and if you are receiving cash, your cash will always what? Increase. The same thing too with our cash in bank. Anytime that we go and withdraw money from the bank, of course our cash in the bank will what? Reduce. And anytime we go and pay money into our bank account, it will what? Increase. Another current asset that would have is what? Debtors. Now, if we are an organization that actually sell goods on credit, we are likely to have debtors. We call them accounts receivables. We are likely to have what? Account receivables, or we are likely to have what? Debtors. That's those that are owing the business organization. And as they pay up, it will either increase or decrease depending on whether they are collecting more goods from us without paying, or whether they are paying for the existing goods they've bought initially. So that's what we mean by what? Debtors. Now, the third category of assets we are going to look at is going to be what? Tangible assets. Now, just know, tangible assets are those assets that you can see, touch, and feel. They are assets that are seen, felt, and what? Touched. For example, you can have a plant, you can touch a plant. You can have a generator, you can touch a generator. You can have a machinery, you can touch a motor vehicle, you can touch a land. All these are physical assets that can be accessed by an individual. Then we now have the last category, which is the intangible assets. Now, what are intangible assets? Intangible assets are assets that have value, but we cannot physically see these assets. They have value, but they cannot be seen, touched, or felt, but they add value to an organization. So, for example, you can have what is called goodwill. So, goodwill is the name that an organization has built over time. That's the reputation of that organization. So, for example, if you want to buy into the shares of Coca-Cola, don't forget Coca-Cola has been in existence for a very long time. You'll be buying as part of the purchase price, you'll be paying for what is called goodwill. Goodwill is the name that the brand has built over a period of time. Then we now have copyright. Copyright is in relation to books. So, for example, once somebody writes a book, he copyrights it so that nobody can write exactly the same thing without taking permission from the owner of the book. Then we now have patent right. Patent right is more related to an invention. When somebody invents an instrument, so you have the right to that particular invention. Then we now have trademarks also in relation to branding of a particular product. So all these are different asset classes or types that we have. The next one we are going to look at is we are going to look at liabilities. Liabilities. I'm sure we have heard of the word liabilities before. Liabilities, loans. So when you usually purchase goods from somebody and you don't pay them immediately, you'll be liable. That means that you have incurred a liability. Now, what are liabilities? Liabilities, these are financial obligations which a company owes to another company or to an individual. They owe to another person. They are financial obligations that a company owes. They are claims that a company has on what? An individual or another organization. Now, what do we mean by liabilities? Liabilities are things that an organization buy, assets that may be bought that have not been paid for, or goods that were bought that were not paid for. All these are what? Liabilities. Now, what are the different types of liabilities that we have? We have the non-current liability. Now, non-current means that we are not going to pay for them within 1 year. They are liabilities that extend beyond one accounting period. So the time for repayment is usually more than a year period of time. Those are what we refer to as non-current liability. So for example, you can obtain a bank loan, and the bank loan, you may be asked to pay it after 3 years or after 5 years. So that would be a long-term liability or a non-current liability. Then we can have mortgage loan. Mortgage loans are in relation to building houses. So if you want to build a house, you can obtain a mortgage loan in order to be able to build that house. Of course, you know it takes a while. Then we cannot look at deferred taxes. Now, taxes that we're supposed to have paid in this accounting period, but one reason or the other, we have decided to move it to subsequent account periods with what we refer to as what? Deferred taxes. Then we now have current liabilities. Now, current liabilities are liabilities that must be fulfilled within one accounting period. The repayment period of the current liability is within the accounting period. It must not exceed 1 year. Those are what we mean by what? Current liabilities. And that is usually determined by the level of business activity. So the first one we have there, an example of current liabilities, you can have your creditors, or call them accounts payable. Creditors are suppliers that we have bought goods from, but we are yet to pay the services of those suppliers, or we have incurred expenses and we are yet to pay for those expenses in which we have incurred. Then we now have accruals. Accruals are more related to services that we have enjoyed but for which we have not made payment. For example, if we have enjoyed electricity for the past 3 months and we are yet to pay up the electricity bill, it will be regarded as accrued electricity bill. Then we now have what is called bank overdraft. Now, bank overdraft is a facility that is given by the bank to an individual to enable him withdraw more than what he has currently in his bank account. It's a facility that is usually given to current account holders. So from there, we will now go to capital, or owner's equity, or shareholders fund. Now, what do you mean by capital? Capital, it is the owner's investment in a business that we call what? Capital. The amount the owner of the business has decided to put into the business. The amount the owner of the business has decided to what? Put into the business. That is what we refer to as what? Capital. Now, the reason why we have it in 3 different names is it can be called capital, it can be called owner's equity, it can also be called shareholders fund. However, shareholders fund is more prominent with companies, while capital is more profound for sole proprietorship kind of business. Owner's equity also is more suitable for companies. So the different types of capital that we have, we are going to look at different types of capital now. So for example, if the owner starts the business with capital, of course, with time he's going to be earning what we call what? He's going to be earning dividend. That's in terms of a company, or he's going to be earning profits. Now, the part of the profits that is being retained within the organization for growth of that organization is what we refer to as what? Retained earnings. Then we can have, in relation to companies, we can have general reserves, we can have revenue reserves, and capital and share capital. Now, in subsequent videos, we are going to go deep into this aspect, but for the purpose of this video, we are not going deep into capital. Now, accounting, basic accounting equation. Now, basic accounting, what do we mean by basic accounting equation? Now, accounting equation is a mathematical representation of the assets and claims, that is liabilities, against a business at a particular point in time. It's a mathematical representation of the assets and liabilities and owner's equity of a business. Now, if you look at the first accounting equation there, you have that asset equals to capital plus liability. Now, don't forget, the accounting equation states that asset equals to what? Capital plus liabilities. The second part of the accounting equation states that asset equals to liability. While the third aspect, which is C, looks at asset equals to capital. Now, for the first one, if the owner of the business has taken part of his money to invest in the business and has also gone to the bank to borrow part of the money to invest in the business, so the owner of the business contributes 2 million while he goes to the bank to borrow 1 million, that is 3 million. So that means that the total asset of the company will be what? 3 million. The 2 million he invested and the 1 million that was borrowed from the bank. However, in B, if he borrows the entire 3 million from the bank without imputing any amount from his own private pocket, without investing any of his own money, then we'll have asset to be equals to liability. Don't forget, he's borrowing the 3 million directly from the bank without having to put his own money into the business. Now, the last part is where he has decided to invest the 3 million of his own personal money into the business without borrowing any amount from either the bank or any other person. Then we can then say asset is equals to capital. So let's continue. So if we look at the three types of accounting equation, you have the asset equals to capital plus liabilities. This refers to the situation where the assets of a company are jointly owned by the owners and other parties who have claims against the business. I've explained that if you have people that are external to the business that have contributed funds to the business, then they become part owners of the business. In that case, the accounting equation will be asset equals to capital plus liability. In a situation where the capital is strictly brought in by only the owner of the business, then you are going to have asset equals to capital. In a situation where the capital is wholly, where the company contracts a loan or obtains a loan from the bank in order to solely run the business, then you now have asset equals to liability. So those are the three circumstances that would have under that particular case. Now let us look at basic accounting equation when it involves other variables. Now, any asset that is not claimed by a creditor will be claimed by the owner of the business. Now, you remember we said it that where you have asset equals liability plus owner's equity or shareholders fund or capital, that means that any asset that is not claimed as a liability will be claimed by the owner of the business. Any asset that is not claimed by a creditor as a liability will be claimed as what? A part of the owner's equity. All claims are against the assets of the company. Now, you have the assets equals to liability plus owner's equity. This leads to the dual aspect concept, which is known as what? The basic accounting equation. Let's continue. So let's look at these practice questions. So if you have been listening to everything I've been saying, you should be able to practice this question if you listen to everything I've said initially. So let's look at them one after the other. Which of the items in the following list are liabilities and assets? So let's look at one. Loan to David. If we are giving a loan to David, David will automatically become our debtor. David will be owing us, and at that stage he will become what? An asset, because he will be liable to pay us back that money. So that is an asset. Loan to David is an asset. Then bank overdraft. I've said it before. Bank overdraft is an incentive or is an allowance that is given to a current account holder to withdraw more than what he has in his account. Of course, he's going to pay back that money over time. So that bank overdraft will be regarded as what? You got it right. It is a liability. Then fixtures and fittings. Fixtures and fittings are assets. Fixtures are fittings. Fittings that you have in your houses that makes that beautifies your furniture, that beautifies the building, are regarded as assets. Motor vehicle is an asset to the organization. Premises are more or less like buildings that you have. They are also assets to the organization. Then loan payable for inventory. You can see the term loan payable. That means it has not been paid. Loan payable. Account payable. That means it has not been paid. So that automatically makes it a what? Liability. So account payable is a current liability. Then we now have inventory. Inventory are represented by stock. So inventory is an asset. Then we have account receivable. We are expecting our debtors to pay us. So if we are expecting our debtors to pay us, it's an account receivable. In that case, that will be what? An asset to us. Computer is also an asset. Don't forget our definition of an asset. Anything that has value, that is owned, that is possessed by an organization for which future benefits are expected to flow in. Then we owe a supplier for inventory. If we are owing, of course we will have the financial obligation to pay for whatever we are owing. So that would be a what? A liability. Then building we own. If we own the building, if we are the owner of the building, of course it is an asset to us. And lastly, you have cash in bank. Cash in bank will definitely be an asset to us. So I hope we are following. You can see accounting, very easy. Just follow the steps as the case may be. Then complete the gap in the following table. Don't forget our definition of an accounting equation. Asset equals to liability plus capital. So in order for us to be able to determine for company A, that will be 500,000 our assets. The liability, that means the owner of this business has contributed 300,000. The total asset of the company is 500,000. That means the borrowed money that was used in the asset, that was used in procuring the asset, is what? 200,000. So for A, the correct answer for A will be what? 200,000. The correct answer for A will be what? 200,000. Now for B, we have the assets equals to liability plus capital. The owner of the business has contributed 250,000. Why? They have borrowed 100,000 from outsiders. That means the total asset of the company will be what? The total asset of the company will be what? You guessed right, 350,000. The total asset of the company will be what? 350,000. Now for C, the total asset of the company is what? 300,000. They have a liability of 300,000. That means the owner of the business has contributed what? Nothing. The owner of the business has contributed nothing. That means he does not have any investment in that particular business. Then D, the total asset of the company is 800,000. The owner of the business has contributed 400,000. That means they have borrowed another 400,000. Yes, you got it right. That means they have a liability of 400,000 naira. Then B, okay, B, that should have been E. So E, the owner of the business has, okay, since we already have this before, I don't think this is supposed to be here, so we can just remove this. We can delete this. Oh, sorry, didn't mean to delete that. So we can remove this entire row. So that should suffice. That should do. So let's continue. Now, the effect of profit or loss on capital. Now, when you start a business with a sum of money, of course, you're expected to make money over time. You're expected to make profit over time. And what does that profit do to your business? The essence of the profit is to improve your business, is to increase your financial status, is to increase the value of the company. Is that not so? Now, let us first of all define profit. Let's define profit. The objective of every business is to make what? Profit. Is that not so? And what profit does is that it increases your capital base in the next period. So let's first of all look at the meaning of certain terminology. So the first one is profit. Profit means the amount by which revenue is greater than expenses. That means your revenue is greater than the expenses of the business. So where the revenue is greater than the expenses of the business, you are going to have made what? Profit. But where the revenue is less than the expenses, you will make a what? Loss. Let me repeat that again. Where the revenue is less than the expenses, you are going to make a loss. But where the revenue is greater than the expenses, so for example, the revenue is 500,000, the expense is 300,000, that means you would have made a net profit of 200,000. Now, what is revenue? Revenue means sales value of goods and services that have been supplied to customers. That's the sales value, what you have supplied to customers, that have been sold to customers. The value of goods and services that have been sold to customers. So that is what we mean by revenue. Why expenses involves all costs, the cost value of all asset that has been used up or that has been consumed by the business. The expenses that have been incurred by the business. That is what we refer to as expenses. So naturally, our profits will be a function of our revenue less our expenses. That should give us our profits. So now let us look at an extended accounting equation. So if we decide to extend the accounting equation, don't forget our basic accounting equation is asset equals to liability plus capital or owner's equity. Is that not so? Now let's assume that we now make profits. So our accounting equation will now be asset equals to liability plus capital plus profits. Then don't forget that we can expand profits. And what's the further expansion of profits? Profits can be defined as revenue less expenses. Is that not so? So revenue less expenses. Now if we decide to collect like terms, we are now going to have A plus EX, which is expenses. You know, the expenses was having a negative value, so we want to collect like terms. We take it to the other side of the equality sign, and that will make it what? A plus. So that will be equals to liability plus capital plus our revenue. So let's continue. So let's look at the effect of profit or loss on capital. Now let's look at this illustration together. On 1st May, the accounting assets, on 1st May, the assets and liabilities of the business are, now let's look at the assets. Assets are building 100,000, inventory 70,000, cash at hand 50,000. Cash at hand 30,000, not 50,000, 30,000. Then the liability, which is our account payable, is what? 20,000. Now, in order for us to be able to determine the capital on this project, what do? Our accounting equation says assets equals to what? Liability plus capital. But if we now decide to make capital the subject of the formula, that means it will now be asset minus liability will give us what? Capital. So we'll add up our total assets, which is 100,000, 70,000, and 30,000, and subtract 20,000 from it. So that will give us what? 180,000. That will give us 180,000. I hope you understand how we got our 180,000. It's just simple. We just made capital subject of the formula. So our capital equals to assets minus liability. Now let's look at the effect of accounting equation on capital. Now look at illustration 2. During May, the whole of the 70,000 inventory was sold for 110,000 cash. Now we had an inventory of 70,000 initially, but we now sold the entire 70,000 for 110,000 cash. Now what will happen? We will not have any inventory again because we have sold the inventory, and our cash value have increased by 110,000. Our cash value will have increased by 110,000. No, so as at 31st of January, our assets will have reduced, and our assets also will have increased. Now our assets will reduce in terms of inventory, but our assets will also increase in terms of the cash value that we have received. So therefore our building will now be 100,000. Our inventory will be nil because we have sold the inventory, but we now have a cash at hand of 140,000. We have a cash at hand of 140,000. Our account repayable will still be 20,000. Now let us now look at the effect of that. That means our new capital will be 220,000. Now how do we arrive at 220,000? If you add the 100,000, which is for our building, with the 140,000, which is for our cash in hand, that will give us 220,000. We subtract that from our initial capital that we had. That will now give us That will give us That will give us a total of 220,000. That will give us a total of 220,000. So let's look at assignment 1. The assignment 1 there says that you should complete the table, complete the graph in the following table, complete the table. Now you are supposed to complete this table. Now the assignment 2 says Femze is setting up a new business. Before actually selling anything, he bought a van for 45,000, an equipment for 20,000, and an inventory of goods for 15,000. He did not pay for the inventory of goods and still owes 15,000 in respect of them. He borrowed 50,000 from the bank. After the event that has just been described, and before trading anything, he has 4,000 cash in hand and 1,000 and 11,000 cash in the bank. Calculate the amount of capital. Now the best way to go about this is just for you to determine how much assets he had at the beginning and determine how much liability is expected to pay, and then you can then find the capital that is required. Now the last part says you should classify this into assets and liabilities. So that's about that. Now this is my WAEC result. I put this up here so that you can draw inspiration from me. You can see in number 5 I had F9 in financial accounting, and that's to show you that if I have F9 in financial accounting, if I can do it, anybody can also do it. So draw. There's no I'm sure your WAEC result was far better than this. So ensure that you put in the work. Just practice the question, listen to everything that I've said, and try as much as possible to make it better. Now if you have ever failed before, always remember that failure is the ability to start again more intelligently, and your mindset is a difference between ordinary and extraordinary people. Numbers don't lie. It is what you put in that you are going to get out of your life. So it's important that you try as much as possible to put in the required effort. Thank you for listening. You can kindly subscribe to my YouTube channel, and if there is any need, you can reach me on any of these social media platforms. You can also send your assignments for grading. I'm going to mark them and send them back to you as soon as possible. I hope this video was helpful, and I'll be dropping other videos with respect to accounting, and I'll see you on the other side.